The acid test. So, what the heck is a tax efficient securities lending strategy anyway? And why do you, as a certified financial planner, or you, as a consumer retail investor, possibly need or want to consider this strategy within a financial plan? Well, first of all, you don't need to do anything. However, perhaps you may want to, regardless of whether or not you decide to integrate this strategy itself. Now, for those who are listening and not 100% sure what the strategy is, I've put a link in this YouTube description from a session I did last year where I walk through the strategy entirely and would encourage you to watch this as well. Now, you also need to know I used to call it an RSP bond overlay, but now I've changed this to a tax-efficient securities lending strategy. But in a nutshell, this strategy suggests that instead of holding your stocks or equity inside an RSP, that you actually borrow money and hold the equivalent amount outside your RSP in a non-registered account, and then invest in lower risk fixed income investments in your RSP to maintain balance. And by doing this, while the risk is slightly different, the overall effect should be a risk-adjusted enhanced return of the long-term assets within your retirement savings plan. Now, the important part of this, though, is do you or do your clients even qualify to borrow this money? And what this analysis, or as I say, this acid test, can tell you about the overall debt situation of the one that considers it. Today, we have many Canadians who have done a decent job of saving money in their RSP, perhaps on their own, or perhaps via a defined contribution pension plan with their employer. That said, they at the same time may have rode higher real estate values and lower interest rates by continually borrowing money via their home equity lines of credit, etc. This in itself can be a very counterproductive to all the RSP savings. And from a financial planning perspective, because, well, you are saving, you are eroding the savings due to still having a significant amount of debt. In many cases, what this means is individuals are currently living beyond their means, and this in itself is a challenge, both financially, but also may have negative social implications in the future if they are to continue in this manner. Now, of course, it's not all bad, given that many Canadians have saved some funds for their retirement, but they may be in a situation where they really are unbalanced and they don't fully realize it. Their current lifestyle choices are starting to affect their retirement expectations, and there's little for financial planners to do other than continually try to talk their clients about it. And while financial literacy is also important, there are a few tools today, in the market right now that can actually give financial planners some, things to assist. A mortgage is already a large leverage component within our financial plans, and yet leverage in most cases is not the main focus of financial advisors versus their RSP savings. Leverage can be used to consume, or leverage can be used to build wealth. Consumer leverage, though, seems to be the only form we're familiar with, and yet it now may be eroding our consumer retail investors' ability to build wealth and security, and it's maybe also stifling our ability to build a strong economy here within Canada as well. If many people are still yet unbalanced, the question then becomes, how do we better understand this both as financial professionals, but also as consumer retail investors? And so, let me suggest that a good place to start may be just simply doing an analysis to qualify for a tax-efficient securities lending strategy. And if you do this, here's what it may start to identify for you. If the answer is, yeah, the individual does qualify, well, this may suggest you're okay as it relates to your debt, but that in itself may not also be the only indicator on its own. You may qualify simply because you have a small amount of RSPs with little or no debt. This still doesn't mean you've got everything in order and may still need to save more or try to increase your returns in one way or another, which, by the way, the strategy could also do for you. But it does at least tell you that your credit certainly is in line. And that's good to know and is exactly what it's designed to tell you. But let's be clear, it's not the end-all of all analysis as much as a tool and another form of analysis for you and your financial planner to talk about and consider. Now, more importantly, it's when you don't qualify and you can't create the strategy itself that is the issue. It then may mean that you or your client may be overextended on credit or have some credit issues. While individuals may still be saving money in an RSP or a defined contribution pension, they may at the same time be spending more than they make. And this, of course, can be a recipe for disaster if left unattended, and obviously something good for everyone involved to know. If we can begin to understand this and look to improve this situation or make other changes to at least ensure they do qualify in the future, because then that should mean their consumer credit is beginning to fall in line. But here's the other thing. I'm not suggesting that you actually integrate the strategy at this time, as opposed to simply start to do this form of analysis for consumer retail investors. And that said, if you do decide to integrate, please make sure you do this with a qualified certified financial planner, chartered professional accountant, and chartered financial analyst. So thanks again for taking the time to listen to this podcast, and please be sure to ask the question at your local bank or credit union for more information on what I'm talking about. All the best, Will Prinzen, founder, Security.